Hello. I think we'll begin. Dr. Celso, can you hear me? Good evening. Dr. Celso, can you hear? Can you hear me?
Ma'am, he's not there. He's disconnected
Okay.
from the call.
Okay. Then we'll just.
I think you can start, ma'am.
Okay. Tajes, I welcome you to this session. You're going to be speaking to the students on a debt instrument. Students, I'm sure you will have a good session where Mr. Tajes Thakur will explain to you in detail what are debt instruments and what is their importance in the share market. I welcome all the students and I also welcome Mr. Tajes Thakur, and I request Mr. Tajes to please conduct this session on debt instruments. Thank you. Over to you, Tejas.
Thank you, ma'am. Yeah. So thank you, ma'am. Good evening, everybody. This is Tajes Thakur here. I take care of trainings for Kotak Mutual Funds, and we have been conducting sessions for you guys. This is, I think, my fourth session now. So today, what we're going to discuss, as ma'am said, is about the debt instruments overall. So we are not going to discuss about debt mutual funds per se, because that will be a separate session altogether. But before you get into debt mutual funds, you need to understand what are debt instruments. Okay, so let me just share the presentation with you and we'll go ahead. So as I said in the beginning, this is going to be about basics of debt market or debt instruments. So this is my fourth session for all of you. Hope you have been enjoying and learning at the same time from all the sessions. So what is the Indian debt market like? Now, if I ask this question to anybody who has spent time in the debt market, will probably take a couple of hours or maybe more to answer this question. But what we are trying to do is we're trying to keep things as simple as possible for you. So let me get the chart in front of you. If I have to put the Indian debt market in perspective, then it has broadly three components: sovereign issuers, the public sector, and the private sector. If we decide to drill down into this, the sovereign issuers are two, essentially the central government and the state government. The public sector could be government agencies, public sector units, banks, FIs is basically for financial institutions, and so on and so forth. Private could be corporate and the private sector banks. So if I do a combination of all these, multiple products emerge. We'll have a look at them. Essentially, from the central government, you have T-bills, dated securities, CMBs. What these are, we'll have a look. Then you have the state government securities, or the SDLs as we call them. Then you have government bonds, which we're not going to do today. We have CPs, which are commercial papers. Yes. CDs, certificates of deposits. Yes, we're going to cover that today. Debentures and CPs. Debentures is not in the scope of discussion today. And CPs and CDs, I already told you we're going to discuss. So some of these we are going to discuss. The others probably you'll have to do some reading on your own. Let's go forward. Now, what is a government security? Just read the word the name properly. It has got two parts. One is government, one is security. So obviously, if it is government, then it has to be issued by the government, okay, for other people to purchase it. Security in the financial terms means that it's an instrument which guarantees certain security of returns, and obviously there is a small amount of risk associated. Now, you heard the word sovereign in the earlier slide. There is something known as sovereign guarantee. So, till maybe 10 years back, all government securities were considered as a sovereign security. That is, nothing can go wrong with it. Till the time Greece happened, and when Greece incident came up, we realized that even the government securities are not safe. So the investors in G6 of Greece typically had to wait for somebody to bail them out, and then they got certain portion of the money back. So sovereign guarantee is no longer associated with G6, but still we'll discuss what it is. It's typically a tradable instrument issued by the central government or the state governments. It acknowledges the government's debt obligation. Now, I want to ask you one question, which you can answer yourselves. Let's see how correct your answer is. Name one person or one organization or one entity which is the largest borrower in India. I repeat my question. Name one individual, one entity, one organization which is the largest borrower in the country. I don't know what your answers are, but the correct answer is the government of India. The government of India is the largest borrower. Why does it need to borrow? Because it needs to run multiple of infrastructure projects, give lots and lots of subsidies, run other government aided programs. It generates cash on its own through the way, by the way of direct and indirect taxes, but still that is minuscule as compared to the government's expected expenditure. Hence, the government needs to borrow. And it borrows from its own people, which is the citizens of India and the corporates and the banks, as well as it borrows from outsiders also, which is international entities, the World Bank, etc., etc. Does it repay it? The answer is yes. Sometimes no, because it does not have a cash generating mechanism. So what it does is basically it rolls over, as we call it in the debt market, rolls over the instruments. That is, I am supposed to pay you 100 crores. I will issue a fresh security of 125 crores. And 25 crores I'll keep with me. The rest 100 crores I'll pay it back to you. So my now outstanding loan amount has moved up from 100 crores to 125 crores. Okay, just basics. I'm not getting into the details of this. So the four types of broad G6 which are there are T-bills, CMBs, dated securities, and SGLs. What are these? We will not get into depth of them, but we will have a timeline in the next slide on which I will plot these so you understand where each one of them is placed. And we'll look at a certain points about each one of them as well. So G6 along the timeline. So if this is the timeline, the first time is from 0 to 91 days. Which product do you have if your requirement is like this? If you need money from 1 to up to 91 days, what product suits your requirement or which is available? That is cash management bills, in short form CMBs. These have been issued lately just to take care of the mismatch which was existing in the demand and supply of G6. Okay, let's move forward. The next time slot is between 91 days to 1 year. That is 365 days. What product do you have for this timeline? You have T-bills. T is short form for treasury. So these are treasury bills. These are issued by the government of India. They are required as a mandate for a lot of things. We'll come to that later in the later part of our discussion today. Okay, so that is T-bills. Next is 1 to 30 years. These are known as dated securities. So dated securities are essentially issued from 1 to 30 years. So if there's a long-term cash requirement, dated G6 are issued. Requirement from 91 days to 365 days, T-bills are issued. Less than 91 days, CMBs are issued. Now we heard one more product in the earlier slide. That was SDLs. So that comes here. So any requirement between 1 to 10 years, okay, I'm repeating, 1 to 10 years is taken care by SDL or state development loans. Like the central government requires money, the states also require money. But that money can be raised only between 1 to 10 years. So this is about G6 in brief. G6 are normally issued by the way of auctions. T-bills, your cash management bills, etc., zero coupon bonds. Okay. The rest, I leave it to you to do a Google around it and find out what the rest are. Alternatively, my videos are available. You can go through those videos and much more details will be shared there with you. So with this, we complete our G6. Next is CPs, which you saw in the first slide. That is short form for commercial papers. So commercial papers are issued in the form of a promissory note. What is a promissory note? If I have to give you a layman's language example of it, it is I owe you. I owe you money. So let's say I'd come to Goa, I'd taken 10,000 rupees from you. I'm supposed to return it back. So I'm owing you 10,000 rupees. That's an IOU agreement. In another word, it would be a loan. You have given me a loan. Okay. But loan has its own formalities which are supposed to be completed. So this is not a loan typically, it's an IOU agreement, or in technical terms known as promissory note. Who issues it? This is issued by highly rated corporate borrowers. Now understand what does highly rated means. If the rating is poor, then will you invest in those papers? No. Why? Because there's a chance of default. Default means inability to return to fulfill a particular commitment. In any commercial paper, what the lender typically promises to the borrower is that he or she will pay interest at regular intervals. Also, they will return the principal back. So these are two promises which are made, and a default could be a risk of any of these two promises or both of them also. So a highly rated corporate borrower would have very low chances of default. Eligibility is 4 crores. Net eligibility, that is not for you. You can leave that point. It is issued for 7 days minimum up to a maximum of 1 year. What you need to remember is that commercial papers are issued by highly rated corporates between 7 days to 1 year. Okay. Let's move forward. Certificate of deposits, short form CD. Again, it's a negotiable money market instrument. Who can issue it? Basically, commercial banks. So commercial banks can issue a CD. This can be issued for a range between 7 days to 1 year again. And it is locked in for a particular period. So let's say a bank has issued a CD for 3 years. It means it will be locked in for a period of 3 years. Now let's say you are invested in this CD and you are in need of money. What can you do? Nothing. Because the bank will not accept it as a repurchase till 3 years are over, or whatever is the lock-in period. So what one more feature they have added to the CDs is that it is freely negotiable. Means that you can sell, you can liquidate it not to the bank itself, but you can sell it to somebody else. Let's say you sell it to Dr. Celso. So for you, the money, the product is liquid. That is, you're able to convert it into cash. But For the borrower at the bank side, it is completely locked. Okay. Normally, what happens is banks also issue fixed deposits, but there is a difference between FD and CD. Fixed deposits are issued, the money is taken from multiple people who want to deposit money with the bank. The pool is created out of that, and from that pool, lending is done. So there is no lock in for any FD. Only thing is, if you break the said uh, agreed period, what happens is there is a cut in your rate. That's the only thing which happens. But CD, what happens is, let's say you wanted to start water sports in Goa. Now, for that purpose, you need money, and you need money for a longer period. You know that it is going to get over, your break even will happen maybe 2 years or 3 years down the line. And you will be in no position to return the money before that. In such situations, CDs are issued. Now, if you go to investors, nobody is going to give you money. So you approach a bank, and the bank does what? The bank arranges for lenders, one or more than one lender, and the arrangement is done. Bank charges its own commission for it. So that is the essential difference between a CD and a FD, fixed deposit. Let's go ahead in our discussion. Now, whenever there is a monetary policy, which is nowadays issued bi-monthly, you hear certain words and you get confused with those words. No need of any confusion. I'll explain 4 of them very simply to you. The first of them being repo rate. Repo rate is actually an acronym, is a short form. It is a short form for repurchase obligation. Okay. You may or may not find it in literatures across, but this is a short form for repurchase obligation. The rate associated with that. What it is, we'll understand it. It is a rate at which RBI lends money to its clients, which is essentially the banks here. So banks are in need of money. RBI will lend it to them. RBI is not going to give it to them free of cost. So RBI will charge a rate. This rate is known as the repo rate. Okay. Now, before we go to this point, so understand that a repo agreement, as we said, it's a repurchase obligation. So it's a dual, there are certain, legs to it, certain parts to it. So first and foremost, the RBI will give money to a bank at the repo rate, which means that the bank has to pay the repo rate to the to RBI. But RBI is still not satisfied. RBI asks for government securities as a guarantee. So in lieu of government securities, which is pledged by the bank with the RBI lends money to the bank at the repo rate. Clear? So RBI is taking money from the bank, as well as RBI is taking securities from the bank as a security purpose. Now, when the said period is over, okay, what will happen is that the bank will return the money which RBI has lended to them. And what RBI will do is RBI will return the securities which the bank had pledged with the RBI. This overall agreement is known as the repurchase agreement. One side rate is known as the repo rate. Let's go and we'll also understand the other side of the rate also. So reduction in the repo rate helps banks to get money at a cheaper rate. Now let's say if RBI was charging 6% as a repo, now it has reduced it to 4%. What will happen? The money is available cheaper to the banks. What does that lead to? That leads, this will lead to flourishing of economic activity. If I increase the repo rate as an RBI, then money becomes expensive. Then what will happen is commercial banks will not be able to lend. People will not be able to take money easily from commercial banks. Hence, a lot of economic activity will be put on hold. So there is an increase in the repo rate is a symbol of tightening the policy. So when I increase the repo rate, you must have heard the word tightening of the policy. So what happens is, if you assume that there is a horse running and RBI is sitting on the horse is the economy, and this repo rate is the are the reins of the horse. Okay, so if RBI pulls the reins of the horse, what happens? The horse will start moving slowly, right? So RBI is the jockey on the horse. The horse is our economic activity, and the reins are the repo rate as well as the reverse repo rate and the other parts of the money market policy. As of August 2020, the repo rate is 4%. This changes regularly. It may not change every time. You have to go to the RBI site and see what changes have happened. So this is the repo rate. Now, the second leg of the story, wherein, as I said, RBI will now the banks will return the money to RBI. Okay, after the said period, and RBI will return the securities back to the bank. Now, in this kind of a situation, there will also be a rate which is applied. Okay, that rate is known as the reverse repo rate, the rate at which RBI borrows from the commercial banks. So there are two parts to reverse repo rate. One part is when the banks who have borrowed money from RBI return the money back to RBI. RBI gives them a rate, and that is the reverse repo rate. That is one part. Second, if certain banks who have not borrowed money, but they have excessive cash, they need to park their cash. They can park their cash with RBI at something which is known as reverse repo rate. Okay. Increase in the reverse repo rate will increase the cost of borrowing. So if I increase the reverse repo rate, what will happen? I will increase the cost of borrowing and discourage the public to borrow money and will encourage them to deposit. As the rates are high, as the rates are high, the availability of credit and demand decreases, resulting in inflation. Increase in the reverse repo rate is also a symbol of tightening of the policy. So if I increase the reverse repo rate also, what happens is I am tightening the policy. So as of 2020, the reverse repo rate was 3.35%. Now, if you are comparing with the earlier slide, you realize that 4% is the repo, 3.35 is the reverse repo. It means the spread between these two is 0.65%. This is what RBI earns for all the deposits made by the commercial banks with the RBI, free of cost. Because the commercial bank's money, which is deposited, RBI gives them money at the rate of 4%. RBI gets the money back at the rate of 3.35%. This spread is the earning of RBI. Okay, so this is about the repo and the reverse repo rate. Let's go forward to two more important concepts: cash reserve ratio, or the CRR. What is it? There is something known as NDTL. So net demand and time liabilities. I know this is getting slightly more complicated, but that is the way debt markets are. We've tried to keep it as simple as possible. So it's the average daily balance that a bank requires to maintain with the Reserve Bank of India as a percentage of its NDTL. So NDTL is a complicated definition. I'm not getting into it. If I have to put it in a very, very simple language, it is all the current account balance, savings account balance, and the FD balance of all the banks in the country. If I have to add it up, this is the NDTL for the entire country. For that particular bank, it is their NDTL. So NDTL is nothing but your, in short, if I have to explain, it is not the comprehensive definition of NDTL. It is CASA, current account, plus savings account, plus FD, RD. Okay, so this is what NDTL broadly means. So what happens is, basically, I'll come back again to the next point, is that RBI doesn't allow 100% of deposits to be given out as loans. So let's say there's a bank which is NDTL is 100 rupees. CASA, current account, savings account, plus RD plus FD is 100 rupees. Should the bank be allowed to lend out all the 100 rupees? No, that is not safe. So there is certain cut in that. So that is one part of the cut is the CRR. Higher the CRR, what will happen? Lower will be the liquidity available and vice versa. RBI is empowered to range a CRR between 5%, 15% to 3%. Currently, the CRR is 3% as of August 2020. Okay, it means that 100 rupees of balance, the loan which the bank can give is only 97 rupees as per the CRR. We'll come to one more discussion. SLR or the statutory liquidity ratio. So what this is, every financial institution has to maintain certain quantity of liquid assets with themselves at any point of time as their percentage of NDTL. So first was cash. Now this is liquid. What does it include? It includes G6, government securities, which we've already studied, precious metals such as gold, and approved securities like SDLs, etc. Okay. So in the first case, CRR, it is cash. Only cash needs to be maintained. Here, you can maintain it in the form of G6, gold, SGLs, etc., etc. The ratio of the liquid assets to the time liabilities is termed as statutory liquidity ratio. Okay. Again, this is a percentage of the NDTL only. As of August 2020, the SLR stands at 18%. Now just add up the SLR and the CRR. So 18 plus 3 is 21%. Means if the bank is getting 100 rupees in terms of current account, savings account, FD and RD, they are allowed to lend only 79 rupees out of that. Because 18 plus 3 is 21. I have to keep 21 in some format or the other. I have a free float which is available with me, which is 79 rupees, and that is the only thing which I'm allowed to lend out. That gives a stability to the Indian financial institutions and also to the overall country as a whole. Now, this is it from my side. So thank you so much for your time. I know the session extended by around 8-10 minutes, but this required some more time to be done. Probably we'll have one separate session where we will look at bonds and we will also look at the schemes which are available in the mutual fund space in the debt segment. Okay. So that's it from my side. Thank you so much. If you have any questions, I'll be more than happy to take them.
Yes, Tajes, thank you very much for explaining this debt concepts properly, especially with regards to the commercial papers and the GCKs, all these basic terms and terminologies we will have to revise. Actually, people will have to actually watch this video again. It is there upload. It will be there uploaded on the YouTube, because in one shot, it's very difficult to actually understand all these things because it's slightly more complicated and we are not that much aware about it. So I'd request all the students as well as all the participants, you can actually view this video. And in the evening, I will send you another video also in short about what are exactly these debt funds.
So there's no sound. Okay, anybody has any questions, you can please ask. You can put it into the chat box as well if that is okay with you. Just one request till the questions start coming in is that all of you go through these concepts, just whatever we have done in today's session. Maybe go back to the video or whatever, but go through these concepts, because if you need to understand debt mutual funds or bonds going forward, these are the basic elementary things which you should know, right? So just go through that once again, so that whenever there is a session on debt mutual fund schemes, it will be easier for you to understand.
Yeah, sorry again, the interruption in the connection. There was a small connection interrupt, but took over. So now that we have learned some of the basic part of it, now coming to the next session, which is another very exciting one, which we have actually come with another national trainer. It is going to be on NPS as well as this gold sovereign bonds. So these are another way of actually doing your investments. And on this, since it's a hot topic now, especially now because the taxation period has come, and many of the teachers and all have requested us to do a session on NPS. So this will be a general session done for all our clients as well as all across Goa on NPS as well as the gold sovereign bonds by Mr. Sunil Jani. He is also from Surat. So he will actually be explaining to us in details about NPS. And this session is going to be on Wednesday, and on request, it will be kept at 7 p.m. instead of 4 p.m. because there are lots of teachers as well as working staff who would actually like to be joining us for this session also. So the next session which we'll be doing is on Wednesday, but it will be at 7 p.m. instead of 4 p.m. And this is for the convenience of all the people who are even working. So, but as a student, you'll definitely need to learn about this, about NPS, because NPS is a very interesting subject, as well as it's a very interesting product, which can definitely help you create wealth for over a long period of time. You only need to understand what are the different types of combinations and composition of NPS, which we'll be explaining to you on the next session on Wednesday. So thank you once again, Tajes, and looking forward to another session in the next week on debt mutual funds, as well as how these debt instruments can be utilized in the best way to create wealth for us. So we can do it in the coming week. So we'll definitely decide and get back to all of them. Yeah. So thank you once again. If you have any questions, you can share it on the group, and we will be putting forward the answers to you on the group itself. Yeah, thank you. And have a great evening now. Thank you.
Yeah, thank you, Dr.